This story begins in the heart of the Caribbean, on the Cayman Islands, a place long known as a sanctuary for capital. With minimal taxation and light touch regulation, it is a haven for hedge funds, venture firms, and multinational holding structures. In that discreet yet powerful financial ecosystem, one particular company was born, Churchill Capital Corp X. From its inception, Churchill Capital Corp X was structured as a SPAC, a special purpose acquisition company. By definition, a SPAC is a blank check corporation formed to raise money through an IPO and later use those funds to merge with a promising private company. It has no revenue, no operations, and no products. What it does have is cash and a story. The entire investment thesis rests on the founder's credibility, the quality of the eventual acquisition, and the investor's faith in timing. When those align, a SPAC can transform from a paper entity into the engine of an emerging industry. When they don't, it collapses under the weight of its own expectations. At the center of Churchill Capital Corp X stands Michael Klein, a seasoned Wall Street dealmaker and former Citigroup executive. He serves as chairman, president, and chief executive officer. Supporting him is Jay Terrigen, the company's chief financial officer, whose task is to maintain fiscal precision and regulatory compliance. Together, they represent the core of what the market has come to call the Churchill franchise, a series of SPACs that have raised billions of dollars over the past several years. Some of their past deals were resounding successes, others ended as cautionary tales. This history gave Churchill X an immediate aura of credibility and equally a measure of skepticism. On May 15, 2025, Churchill Capital Corp X went public on the NASDAQ exchange. Each unit was priced at $10, consisting of one share and a fraction of a warrant. In total, the IPO raised more than $400 million, which was deposited into a trust account, untouchable until an approved merger was finalized. This is the standard SPAC framework. The money exists, but cannot move. Investors, in effect, buy into potential, not performance. Then, on July 7, 2025, the company announced that its units would separate, allowing the common stock and warrants to trade independently. Normally, such an event passes quietly in SPAC cycles, but this time it did not. The share price surged from $10 to $27, an almost 170% increase, despite no operational updates or merger targets disclosed. Such a dramatic move for a shell company was highly unusual. In traditional SPACs, price movements before a deal announcement rarely exceed 5 to 10%. This anomalous rally immediately sparked speculation that insiders or institutional players anticipated a major acquisition. The rumor mill turned, and all eyes shifted toward what Churchill X would reveal next. 2 months later, on September 8, 2025, the mystery came to light. Churchill Capital Corp X announced a definitive merger agreement with Infleqtion, a cutting-edge quantum technology firm specializing in neutral atom quantum systems. The deal valued Infleqtion at a pre-money valuation of $1.8 billion, supported by $400 million from Churchill's trust and another $100 million in PIPE, private investment in public equity funding, a total transaction size exceeding $500 million. The merger announcement, released after market close, electrified investors. The next day, trading volumes spiked, message boards flooded with optimism, and the stock jumped once again. For a brief moment, it appeared to be the perfect SPAC story: capital, credibility, and innovation converging in one line. But beneath that optimism, something didn't add up. Infleqtion positioned itself as a quantum company with existing commercial revenue, claiming to generate income from quantum sensing products, devices that leverage quantum states of neutral atoms for ultra-precise navigation, timing, and defense applications. Yet investors quickly noticed that the company provided no hard data on the nature of that revenue. Was it based on long-term contracts and recurring government orders, or was it derived from one-time research and prototype sales? The distinction is crucial. A stable, recurring revenue base signals a scalable business. Prototype-based revenue indicates an R&D stage enterprise still dependent on grants or pilots. Without detailed disclosures, the credibility of that revenue claim became the first major mystery in Churchill's merger narrative. The second mystery lay in Infleqtion's customer mix, particularly its reliance on defense and government contracts. In the U.S. government contracting ecosystem, budgets are renewed annually, and programs can be canceled or delayed due to shifting political priorities. Defense contractors with narrow portfolios face recurring budget risk. While civilian market diversification mitigates this, Infleqtion's disclosures suggested a heavy dependence on public sector clients. That imbalance raised a deeper question. Was Infleqtion's growth truly technological or merely fiscal, driven by government cycles rather than commercial demand? The third mystery came from the capital structure itself. While Churchill's $400 million trust account looked robust on paper, in the SPAC world, what matters isn't the gross amount raised, it's how much remains after redemptions. Redemption occurs when investors, given the option to withdraw their money before a merger, choose to do so rather than hold the merged company's stock. In most SPAC deals, redemption rates range from 40% to 90%, depending on market sentiment. If Churchill X experienced a high redemption rate, the post-merger entity could be left with less than half the anticipated cash. That would mean less runway for R&D, fewer resources for scaling, and weaker balance sheet flexibility. Yet, as of the merger announcement, the company offered no guidance or projections on expected redemptions, a silence that worried analysts. Adding further complexity were potential dilution factors, sponsor shares, warrant exercises, and follow-on financing. Each element, if triggered, could reduce the effective ownership of public shareholders. In a traditional merger, dilution is modeled in advance. In a SPAC, it unfolds dynamically, often only fully visible after the merger closes. This structural opacity compounded the sense that investors were navigating in the dark. As these uncertainties converged, Churchill X's stock became a case study in volatility. Prices swung wildly within single trading sessions, driven by bursts of enthusiasm and waves of doubt. The word quantum carried almost mythic weight, evoking the next great technological revolution. But hype is not the same as revenue. Quantum computing remains an experimental frontier, while quantum sensing, the nearer-term application, represents only a sliver of the broader opportunity. If the bridge between the two technologies fails to hold, valuations built on both could crumble. Between September and October 2025, Infleqtion participated in high-profile events, including NVIDIA GTC and Q+AI, where it unveiled its product roadmap and partnerships. Yet once again, no concrete figures on backlog, margins, or recurring revenue were provided. Investors who once felt excitement began to feel unease. Without numbers, even the most visionary roadmap becomes speculation. Ultimately, three critical questions remain. First, how much actual cash will remain after the merger closes? The real liquidity will dictate whether Infleqtion can execute its roadmap or struggle to fund operations. Second, is the revenue truly recurring, scalable, and defensible? Without sustainable contracts, today's sales may be tomorrow's evaporation. Third, does the current valuation, a $1.8 billion pre-money figure, rest on realistic assumptions about growth, margin, and market share? After accounting for all dilution, what is the real per-share value? If the answers to all three are yes, Churchill Capital Corp X will stand as one of the few SPACs to deliver real substance behind its story. But if not, it will join the long list of speculative vehicles that promised revolutions and delivered uncertainty. Until that verdict arrives, this saga remains one of the market's most intriguing unresolved puzzles, where quantum physics meets financial alchemy and where investors must separate science from storytelling. Before we close, the ValueStir channel invites you, our listeners, to share your insights and tips on intriguing stocks, both listed and unlisted, or upcoming IPOs and cryptocurrency projects that deserve deeper investigation. Your comment might become the spark for our next feature. We also extend sincere thanks to everyone who watches, subscribes, likes, comments, and shares our videos. Your engagement is the energy that powers better research and better stories. This was ValueStir.